SPACs are super hot and a great way for average regular investors to get in early on initial public offerings or IPOs with companies. But what exactly are they? And what's this business about SPACs being a blank check company? We're going to learn all about that and more coming up. Hi there and welcome to the channel where we help you to learn fast so you can gain confidence and become a successful investor. If this type of information seems interesting to you, go ahead and click that subscribe button. Okay, an upcoming video that's going to follow after this is actually from my complete course on SPAC investing. It's on the investing educationwithmrb.com website. All the links and everything and other information is below here in the description. So take a look at that. So you're going to see this part from that course, and it's going to talk about, well, what are SPACs and blank checks and all that, blank check companies. So if you're intrigued by that, then check out the course. And you'll find links to other courses and free courses and guides and all sorts of good stuff. So let's get started by learning about SPACs and what does SPAC stand for and how does it kind of work and get learning about that. So let's get started. Okay, let's start by understanding what is a SPAC. What exactly is a SPAC? And what does it stand for even? And a SPAC is like an IPO or initial public offering. It helps private companies go public in partnership with the SPAC company. So it's like an IPO, but it's different in a lot of ways. Sometimes it's known as a reverse IPO, or you may have heard the term blank check company, which is interesting. The next lesson talks a little bit more about blank check companies. But a SPAC is like a blank check company. So what do we mean by all that? And what is exactly a SPAC? So first off, a SPAC stands for Special Purpose Acquisition Company. Think of it as its purpose is to acquire things. Its special purpose is to acquire other companies, private companies, and make them public. Now, the interesting thing about SPACs is they have no operations. They don't make anything. They don't sell anything. They don't provide a service. Unlike a regular company that might trade on a stock exchange, they don't make anything. They don't have any services. So that's interesting. No operations. They do have cash. They have lots of cash, hundreds of millions of dollars in cash. Some of that cash, it might be your cash that you've invested in them as far as that comes. So they don't make a product or service, but they have cash. And they're going to do stuff with that cash. And that's where the special purpose acquisition part comes in, is their sole purpose is to raise money in their own initial public offering, basically the creation of the SPAC. They raise money from various sources that we learn about. And one of those sources is from you and I investing in it. That's the whole purpose of the course, is investing in SPACs. And so they raise this money, and the whole purpose is that they're going to take that pool of money, which is actually held in a trust account. We're going to take that pool of money and we're going to buy or merge or acquire another company. We're going to acquire a private company, and they're going to help them become a public company. And that's what a SPAC kind of does. So that's the idea behind them, is their whole purpose is to raise money and then to buy another company. And so if they don't have any products or services or anything like that, well, what are you kind of investing in? What are some of the early conceptual things in terms of like, which SPACs do I choose? There's different ones. And what do I look for? Just early concept-wise, let's look at that. One, you're really investing in a management team, particularly people with a proven venture capitalist or VC or merger success, people who have experience in particular industries or finance, and can have success bringing companies from private to public. Or they might know a particular industry or sector very, very well as part of that. And maybe you're investing in part of a concept. Maybe you like the idea that EV or electronic vehicles are the wave of the future, or technology, or certain subsets of technology, or even cannabis, that these are industries that have a real upside to growth, and you want to invest in them, and you want to invest in companies that are maybe going to go public. It might be smaller or emerging companies, not necessarily small, but emerging companies, right? So you're going to invest in that investment team, you're going to invest in that concept, and that investment team is going to basically help find a candidate that they're going to then merge with and help go from private to public. So when you give them your money, what happens to the money? Well, the initial investor money is kept in a trust, kind of locked away. Investors can choose later to redeem their shares for a prorated amount of the share of the trust account if they do not wish to own the new company. So that's kind of an interesting idea, right? So you can invest in it, and if you don't like when they become public as far as what the investment's going to be, you could basically kind of get your money back. We'll talk about that in more detail. But basically what happens is so there's a lot of upside, less downside. Now, upon formation of a SPAC, One thing is that it becomes publicly traded. It's been created. The SPAC is now traded. Price of the SPAC can go up or down. It's still just an idea at first. There's no name target when it's first listed. So it could take some time to find that target, and they have a defined timeline to do that. So it could take time to do that. But right now it can go up and down in price. Usually it stays around the same. A lot of times, typically it's $10, by the way, US. But you can, it's just that whole concept, that idea. And the price to buy now will go up or down like a stock. It will certainly change more once a target is announced. But in the pre-phase, before the target is announced, it typically doesn't fluctuate very much. So SPACs will typically grant management an 18 to 24 month or 2-year period in which to either complete an acquisition or return the money to the shareholders, right? So if I'm investing, I'm a shareholder, I could buy, sell it on exchange, but if I invest in it, it's in a trust, we're going to complete that acquisition, or if we can't get a deal done, we're going to return the money to the shareholders. And all the terms that are spelled out in the prospectus, what's the term is an S1 here in the SEC or United States lingo, but either way, there's a prospectus that outlines all these different types of terms. In the course, we're going to learn about these different types of things and these terms and how to read prospectuses and look for the key things that will be all covered in the course. So yes, you get your money back if you do not like the acquisition. Let's say you get your money back early, but let's say they announce, oh, we want to merge with this company, and you say, I don't like that. I don't want to merge with those guys. You could vote no, and if enough people vote no, then it doesn't happen, by the way, because you are a shareholder. But if let's say enough people say vote yes, but you still don't like it, well, there's a period of time before the acquisition becomes kind of finalized where you can redeem that money from the trust, prior to that IPO completion. Kind of like that whole idea of getting back to that, maybe that $10 per share you put in as an example, for example. Now you miss out on the upside or maybe the downside, but you can have that ability to get out. But meanwhile, during that time period, your money is locked up during that timeline as far as the 2 years, especially if you're an earlier sponsor or something like that. And then what happens is after the merger, the SPAC is dissolved, right? The SPAC whole purpose is to acquire a company, goes merge, makes that private company public. That public company is now traded as a new IPO or initial public offering on a stock exchange. And the SPAC company that you've been buying under a certain symbol now becomes that new publicly traded company. So your shares basically convert. If you don't sell them beforehand, which you could do, or redeem them, you become now the owner of this new, hopefully exciting, emerging type company. So for example, a SPAC called Social Capital Head Sophia Holdings was trading under IPOA, so you could buy and sell shares under IPOA, invest in that SPAC. We're going to learn all about SPACs. But once the deal is finalized and completed and 100% completed, there'll be a magical day where that IPOA will no longer be available as a trading thing, and it'll become now, in this case, Virgin Galactic or SPCE. Commercial tourism, space tourism, some commercial stuff they do too, an emerging technology for sure in terms of space travel and space tourism. Yeah, I would say that's pretty emerging. So that's what happens kind of along those lines where it becomes this new company. So it seems like a can't lose situation, right? Like, oh my gosh, I can get redemptions. It seems like you can't lose. Well, there's no such thing as a free lunch, as they say, right? So you can lose money. There is definitely an opportunity cost where your money can be tied up for a couple of years. If you invest and leave it there, it can be tied up for 2 years while they target and find a company to get a deal done. Most times they get a deal done well before the 2 years, but it could be up to 2 years, or it can never get a deal done so that you get your money back, but you've lost out on the opportunity to invest in other things or even buy a car or take a trip, whatever, because your money's tied up. The SPAC could trade below what you paid for. Once it's publicly listed, that SPAC, before it merges with another company, it goes up and down in value, and people evaluate that SPAC based on the management team, their target, other things are happening in the market. So that can go up and down in price. Usually I'll hover around at the beginning, but it can go up and down in price, especially after an announcement. And you could hold and get that new merged company, like that Virgin Galactic, for example, and the stock could go down afterwards. It could tumble quite a bit. It could stay down. It could never recover, and you could lose money that way. Just like stock prices go down, like any stock would go down. But a SPAC will give you an opportunity to get in kind of early on the ground floor, where a lot of cases, especially with traditional IPOs, retail investors, people like you and I, are usually pretty shut out as far as getting in that. So that's very, very quickly an overview of what a SPAC is. There's a lot of detail on it, and that's the whole idea of the course, is to give you that great detail and how to pick out the right SPACs and all that too. So as you go through the course, you're going to learn quite a bit and see if this becomes a great opportunity for you in this great growing area. And SPACs are a growing area, so it might be a great, great opportunity for you. Oh, what about that thing about the blank check companies too? What do they mean by that? Well, that's the next lesson. So let's learn why they call them blank check companies. Okay, so special purpose acquisition companies, or SPACs, are sometimes referred to as being a blank check company. So why? What do they mean by that as a blank check company? So if you recall the previous lesson, SPACs don't have any operations, they don't make anything, they don't provide a service. The sole purpose is to raise money for an IPO, to buy another company, for the SPAC to become an IPO, and then they trade it, and then they're going to use that money to buy another company, a private company, and bring them public. And then their shares will convert from the SPAC shares to the public company. That's all they do. So, but to do that, this is where the blank check part comes in, right? You don't know anything about, especially early on, you don't know what companies they're going to buy. You might say they're interested in investing, the SPAC is in a certain industry, but you don't know what specific company they're going to buy or whether they'll even adhere to that. They should if it's in the prospectus, but you don't know. You're going to trust them to make a good purchase. You're putting your bet on that management team, the people who are deciding that stuff. They're experienced in certain industries, whatever that industry might be, and you're betting on that management team. A lot of them have come from hedge fund or venture capital type things, so they could be people you really maybe would trust. And that's the whole idea, is you're giving all that trust to them. You're in effect sort of like writing a blank check. Like, here's my money. Now you go figure out what to do with it. I trust you, right? But what I want is I want you to give me an ROI, or return on my investment, and I want to make money on it by giving you that money that I trust with you. So that's the blank check aspect of. I don't have much to go on as far as evaluation, other than some of the things we're going to learn in the course, but a lot of it is based on that management team, based on that trust, and that's the whole, blank check nature of it. So in effect, I'm writing a blank check to management. Here's the money. You decide what's best. I trust you. Hi, it's Mr. B back here again, and SPACs are kind of fascinating, aren't they? Aren't they a little bit interesting? Maybe if you want to learn more, of course, go ahead and take a look at all the description, all the information below, and check out the course, the full course as well. We have some preview videos there as well that you can check out as far as learning a little bit more of SPACs even before you invest in the full course. But everything's all below. So I hope this helped you understand a little bit about SPACs. If it did, give the video a like, or certainly subscribe to check out some of the other videos that we have here as well too. So with that, I wish you all the best of luck in your investment journey.